Alice, and I'm here to share with you about the market updates. How the market sees a hard and soft landing of the US economy, and the third possibility, no landing. With the economic data in the US and other regions stronger than expected, a new option of a no landing is in the heated debate. Discussions about the possible development of the US economy have been compared to aircraft trying to land. Until recently, the market divider has focused on the choice between a hard landing and a soft landing, while an alternative economic collapse is a possible option was cleverly ignored. In recent weeks, with stronger than expected economic data from the US and other regions, a new option for a no landing is also under heated debate, but market often tend to not focus on the fact that when the plane never lands, it eventually runs out of fuel and crashes. The Zhitong finance app learned that there are a lot of problems. Most importantly, the landing is a binary problem. For the pilot, either land safely, leave the plane safely, or crash. There are even greater subtleties in the case of economic and market development. Among them, the economy must continue to grow, not end flights on its destination. So the Fed's role is very important. A no landing, or the worst case scenario, means that US unemployment will not rise sharply, and the growth rate will not fall, and the economy will continue to rebound, buoyed by the reopening of China or sustained growth in US consumption. But is this a good result? Ed Yardney, the founder of Yardney Research, believes that the key question is whether it'll bring about higher inflation. If so, it thought it'll be worse than harder landing and introduced an additional category. For the stock market, if inflation continues to be moderate, the bullish scenario is both a soft landing and a non-landing scenario, and the hard landing will be pessimistic. Even more pessimistic is a rebound in inflation, and the economy is not landing. In the end, the Fed will be forced to raise interest rates long enough to trigger a recession, thereby reducing inflation. Earnings and valuation multiples in the stock market will be crushed, and shares will be well below their record low on October 12th. David Powers, of Absolute Strategy Research, also said not landing could be the worst outcome. It is said this lead would lead to a renewed acceleration in global economic growth ahead of any idle capacity or economic weaknesses. He added that, to bullish bond investors, the Fed's policy rate may have to stay higher for longer. In the case, it is only a matter of time not to land. After all, the plane has to land at some point. Chief Alan Zentner, chief U.S. economist at Morgan Stanley, said the non-landing is just waiting for the upcoming soft or hard landing. She explained, in both hard and soft landing scenarios, the Fed is pursuing higher neutral rates in the short term, seeking appropriate restrictive rates. In pursuing neutrality, the next rate move after the impulse may also rise. If the Fed manages it, the economy will have a soft landing. Failure to succeed is a hard landing. In fact, the market may think that the Fed's higher interest rates could increase the possibility of a hard landing, albeit a little later. Above importantly, the Fed's choice is not to cut rates at all, but to bring inflation under control. If the economy is unlikely to land, it will directly mean that the Fed will raise interest rates again in the near term. How to define a recession? One of the broader questions in the market debate is how to define a recession, and the health of the economy is crucial to predicting the direction of a risky asset. If there is a recession, people tend to lose even more money. Longview Economics' Chris Watson believes that if an economy avoids a recession, it is a soft landing. Otherwise, it is a hard landing. It is crucial for the stock market because recession-related bear market cycle never ends before the recession begins and tends to be worse. Without avoiding a recession, it is hard to believe that stocks have bottomed out. It is hard to argue against this, but using the concept of a recession as a dividing line is problematic because it is not easy to define, especially in current weird environment. America had 2 consecutive quarters of negative GDP growth last year, but employment and consumption were so strong that it would be absurd to say that the US has already experienced a recession and recovered from it, according to Eric Burton of the Fathom consulting firm in London. In the UK, where growth trends may be well below 1%, a technical recession is no longer a relevant concept, which is unclear. Instead, we use sharp rise in unemployment as a sign of a UK recession. So far, there is no evidence of this. Unfortunately, we get little comfort because rising unemployment is often a lagging indicator of recession. The logic of the US and UK is roughly the same. Even if Watson says market divergence is nearly binary, there is another view that the concept of a soft landing is meant to glorify the possibility of a recession. Soft landing or hard landing, the market is debated. As T.S. Lombard, Dario Perkins points out, the soft landing tends to encourage people that there may be a recession, but it'll be very mild recession. So, in part, the situation is an attempt to induce people to believe an incredible result that will at least prompt them to buy more risky assets. When contrarian investors look at the details of consensus forecast, he says, they found that everyone was predicting the mildest recession ever, from a soft landing. If the 2023 recession theory is based on a sell-side marketing campaign, the only way to really break expectations is to look for why the recession is worse than everyone expected. However, this analysis is often based on superstition or the PTSD of the 2008 financial crisis, rather than viewed based on macroeconomic data. Perkins even calls a pseudo-cycle. There are some problems when applying the aircraft analogy to our current situation. The accepted economic expert on this concept is Alan Blind, a former chairman of the Federal Reserve Committee and now a professor at Princeton University. When the Fed hits inflation, according to Blind, it'll either achieve a soft landing or force a recession, though 7 of the 11 rate hikes since 1965 have ended modestly. The problem is that it will be difficult to control inflation by raising interest rates after inflation rises to such high levels. By his definition, Alan Greenspan demonstrated a perfect soft landing in 1994 and 1995, when inflation was relatively stable at 3%. Growth slowed from 4.4% to 1.3%, and unemployment remained at 5.6%. Brand noted that despite the huge volatility in the bond market at the time, a soft landing was achieved without declining real GDP. The unemployment rate is now nearly 3.4%, so there is certainly room for rise. Of course, inflation is still far above the Fed's target, and the longer it stays at the current height, the harder it'll be for the economy to land smoothly. Bank of America, a hard landing in the second part of the year, said in a recent research report that a resilient economy so far means interest rates will remain higher for longer. It expects what is so-called no landing in the first half of the year, meaning economic growth remains strong. The Fed may remain hawkish for longer, with high interest rates after the hike. Expects a hard landing in the second half of the year, 2023. Earlier this week, Bank of America's Global Fund Manager survey showed that most of investors do not believe the market rally in 2023 will continue. Michael Hutnett, led by the Bank of America strategist team, said in research report, according to recent economic indicators, show that the Fed to reduce inflation mission. largely unfinished. They expect the S&P 500 index will fall to 3,800 points in the next 3 weeks, down about 7% from the current level, after the index failed to break through the limit of 4,200 points. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.